is there a possibility for the SPX to actually slow down if the breadth of the instruments within them are slowing down or breaking down?
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's bonkers.
Welcome to another episode of Talking Trades with me, Kevin Wadsworth, and my friend and colleague, Patrick Karim. Today we're going to talk about market breadth indicators, what's going on with stock markets in particular, and how the market breadth indicator sheds a light on the stock market that perhaps you wouldn't otherwise be aware of. Patrick, take it away.
All right, guys. Look, market breadth is how much of the stocks in an index are above a moving average. In this case, we want to choose a moving average that's a little longer. So we'll take, let's say, the 200-day moving average. So even while an index, let's say SPX 500, guys, it has 500 stocks in it, right? But is it really healthy? Are all the instruments or most of the instruments in that index going upwards, or it's more heavily weighted, right? There's just a handful of those stocks that are really outperforming, making that SPX 500 chart go up. But most of the other, let's say the 90% of them, are dwindling sideways or even declining. So that's important, right? You want, in a strong bull market, you want the breadth, the width of the instruments within the index. You want them to be above their inclining moving averages. You want their individual charts to look like the SPX 500 chart itself, right? So once in a while, it's good to check up. Even if the SPX is going up and up, it's above its inclining 12-month moving average, above rising trend lines. Hey, what's the breadth doing? Is there underlying weakness we should be aware of? Doesn't mean that there's a top, doesn't mean that you short the SPX 500, but is there a possibility for the SPX to actually slow down if the breadth of the instruments within them are slowing down or breaking down? So the best thing I could do right now, guys, is I'll show you the actual chart. Right here, what I have is the SPX 500 daily chart with its 200-day moving average. So just like I explained to you guys, here is the SPX, that's back in 2021, trending upwards, above an inclining 200-day moving average. Nothing apparent to the eye, right? If somebody would say, Patrick, look, why are you thinking there's bearish omens there set up for the SPX? Look, it's above an inclining 200-day moving average. Fine, objectively, you're correct. Bottom pane. I have the indicator. I have what's the percentage of stocks within the SPX 500 that are above their 200-day moving average, right? And here, 80% the top range, here all the way down here, 20%, but it could range, right? So you see here, as it was going up and up and up and up, the breadth was following, but eventually the breadth started going down. So instead of having 80%, a very high percentage of the stocks trending upwards, less and less of those stocks were going upwards. It doesn't mean the index stops going up. It means we're setting up some bearish divergence, right? Higher highs on the price, lower highs on the indicator is telling you that the majority of the stocks are not participating anymore, right? As soon as you're below 50%, then that means less than half of the stocks are above their 200-day moving average. So even if the index kept going up, you have less and less strength overall. So this is step one. Notice this bearish divergence with the price action. It doesn't mean you go short. But right, if ever the price breaks down below the 200-day moving average, I could have drawn a rising trend line here, right? You see the price, it's distancing the 200-day moving average less and less and less. Once you get that close here, then say, okay, I've activated my bearish divergence with the breadth. The breadth is not going up higher, and now it vomits. It's in free fall. You consume that bearish divergence, and then you go in the negative zone. You go below 50% of those instruments, below their 200-day moving average. And that drags down until eventually you get the inverse divergence, right? You have the price that keeps going down when you're starting to climb up the breadth. More and more are participating, and then you get a new uptrend until you get like this. And once again, guys, just like this run here from 2021 all the way to 2022, the breakdown, the huge correction, this is the power zone right here, right? Majority of instruments were participating in this huge rally up for the SPX. But look what's happening here. The breadth, while the price of the SPX went sideways and up here, look at this huge fall in breadth. below a declining breakdown line. A breakdown line, guys, you need 3 valid touch points. This one has 1, 2, 3, 4, 5, 6, 7 touch points. Very, very valid trend line. Declining, breakdown, retest. Goodness, it's like this is, the breadth is not participating. It's deteriorating. It's a bearish omen. Does that mean you short the SPX right away? No. Look, it could, in hindsight, we'll find out. This could have been the top. But right now, all you have to do is keep a close eye on the SPX, because if that SPX starts losing, I could have drawn here support line. If it starts tagging the 200-day moving average, if it starts closing below the 200-day moving average, you've got a more serious issue on your hands, because that breadth is telling you that there's no support. There's no market. The breadth, it's not all the instruments within the S&P 500 or the majority of them helping support that price action, right? Right now, this is what it's telling me is less and less stocks are pushing this index higher and higher, right? It could be NVIDIA, it could be Microsoft, Apple, you know, the Magnificent Seven, they're pushing that up. So right now, look, we're vulnerable right now. It's if there'd be a chance to have a repeat of the 2022 correction that starts going down here, look, it's right now, guys. So this is how you use breadth. You look, if it's in the power zone and doesn't break down, you're fine, steady as she goes, healthy market. If it starts breaking down and the price is doing higher highs and the breadth refusing to do higher highs and it's starting to fall, and like it's at 52% now, falls in negative territory, then you're more susceptible to having a more important correction. And remember, all bear markets start with short-term corrections that don't resolve immediately to the upside, and then they cascade onto the higher time frames. So you got to be really careful about that. And that's, guys, how you use market breadth to see the underlying capacities, evidence of the SPX continuing its uptrend or being vulnerable for a correction to start.
Thanks, Patrick. That's awesome, actually. And also looking at that chart, I've just noticed that the recent uptrend for the S&P has taken, obviously, the S&P higher than it was in 2021. But when you look at your percentage of stocks above their 200-day moving average, the green shaded area on the recent uptrend is smaller than the green shaded area on the past uptrend. So that's yet another hidden divergence. We've gone higher on the S&P with less surface area below that graph, which is another underlying weakness, another underlying indicator. Brilliant stuff there, Patrick. I hope you all enjoyed that as much as I did. Don't forget to like, subscribe, and hit that notification bell, and we'll see you back here for more.